Thinly traded options can look tempting, cheap contracts, unusual setups, or big payoff potential. But hidden behind those numbers is a serious risk: liquidity traps. In this video, we'll break down what liquidity traps are, why they're dangerous, and most importantly, how you can avoid them. What is a liquidity trap? A liquidity trap happens when an options contract looks tradable, but in reality, there isn't enough market activity to enter or exit efficiently. You'll notice things like low open interest, very few contracts outstanding, wide bid-ask spreads. You might see a bid at 50 cents and an ask at $1.50. Low volume, hardly any trades going through. On paper, it looks like an opportunity. In practice, it means you could get stuck, unable to trade at a fair price. Why liquidity matters? Liquidity is your ability to get in and out of trades smoothly. In highly liquid names like SPY or AAPL, spreads might be just a few cents, and you can trade size quickly. In illiquid names, every trade feels like swimming through mud. You either overpay to get in, or you're forced to sell at a huge discount to get out. This slippage can completely destroy the edge of your strategy. You might be right about direction, but wrong on execution, and still lose money. The hidden dangers. Thinly traded options aren't just inconvenient, they're dangerous. Getting trapped. You can enter a position but find no buyers when you want to exit. Overpaying. Wide spreads mean you'll almost always give up edge to the market maker. Unreliable pricing. Option models assume fair value, but when no one trades the contract, the quotes can be meaningless. False sense of opportunity. Unusual activity might look like a hidden signal, but in reality, it's just noise in an illiquid market. In short, liquidity traps can make even a perfect strategy untradeable. How to avoid liquidity traps? So how do you steer clear? Check open interest. Look for contracts with hundreds, preferably thousands of open positions. Watch volume. Make sure contracts trade regularly throughout the day. Evaluate spreads. Tight bid-ask spreads, a few cents wide, are safer than dollar-wide ones. Stick to liquid underlyings. ETFs and large-cap stocks usually offer better liquidity. Use limit orders. Never chase the midpoint blindly, and avoid hitting market orders in thin contracts. By following these rules, you'll save yourself from unnecessary risk and wasted capital. To recap, liquidity traps hide in options with low open interest, wide spreads, and low volume. They make it hard to get in or out, often forcing you into bad fills. Protect yourself by focusing on liquid names, monitoring spreads, and using limit orders. Remember, in options trading, execution is just as important as strategy. Thanks for joining us. If you found this video helpful, hit like, subscribe for more advanced trading insights,